Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and happy Sunday to you. Is it me or the Blackhawks are decent, the Bears are decent, and the stock market is decent? This hasn't been a whole lot of trick. It's been a lot more of treat. We've got a jam-packed show. It's everything that you need to make sure that you get retired and stay retired. So I don't know. Let's just jump right into it. Hey, in case you didn't know, we got some data. Yeah, even though there's a government shutdown, we actually got some data. I might be missing retail sales. I might be missing jobs numbers. I might be missing GDP, but I did get the inflation number. I was holding my breath. I was nervous as a long-tailed cat in a room full of rocking chairs. But when it came out, I breathed a sigh of relief, and then I shook my head. Why? Here's what we learned. We learned that inflation is running 3% year over year. Well, 3% seems nothing at all like the 2% mandate that the Fed wants. But you know what? 3% was a little bit cheaper than the 3.1% we expected. Now, why am I talking about this? Simple. 3% is not a bad number. 3% is not financial Armageddon, but it is a higher run rate than that through which we've all been used to for the last 15 years. And I've got news, everybody. If your core CPI is running at 3, you need to make sure that all of your income streams, that is your portfolio income streams, are at least running at 3. Because if you're coming up short, that means you're giving up ground. That means the money you have isn't going to buy as much in the future, and that's a problem. Oh, wait, did anybody know what we got on Friday besides the inflation data? Oh, yeah. Let me tell you what we got. Social Security. They just announced their 2026 COLA increase. Oh, the COLA that affects 75 million Americans. It came in at 2.8. Seems like the price fix is in, everybody. You got a 2.8% cost of living on Social Security, but you just learned that the same governmental data told you that inflation was 3. What are you going to do about it? Well, David's joining us in the studio. David, how do you solve for this conundrum, which is the silent killer? Again, we're not talking hypertension. We can just take some lisinopril or HCTZ for that. We're talking about inflation. That is the silent killer. And David, here it is again. I say the fix is in. Social Security, 2.8% cost of living. Same government that provides Social Security, 3% CPI on Friday. What say you, and how are you solving it for clients of VestGen all across the country?
Well, it certainly doesn't feel like 3% when you go to the grocery store or you pay that utility bill. So I think when we're planning for it, a lot of times, we run mock retirement scenarios. We run inflation at a higher than a 3% rate, right? Because we need to plan for the worst and certainly hope for the best. But I don't think there's a one size fits all, Craig, right? There are lots of different strategies that people can explore. But I think the important part and the takeaway from this data is you, the retiree, are responsible to grow your income, because clearly by the data that we just got, the government's not going to do it for you. So let's maybe break that down into a couple of different parts. One thing we talk about a lot is the equity portion of your portfolio. And we want to make sure the equity portion can generate dividends. But dividends come in all different shapes and sizes. One of my favorite parts of the market is dividend growers. And I love dividend growers, Craig, because it gets us access to not just one or two sectors of the stock market, but dividend growing stocks come in lots of different sectors, and it lets you participate in some of these big themes that we always talk about on this show, like technology as an example. Give us an idea of what a dividend grower is.
Ooh, people don't get excited when they see a dividend go from 50 cents a share to 54 cents a share, because they go, what am I going to do with 4 cents? Well, wait a second, everybody. Finance is all about math. It's about zeros and ones. If you have a company who just increased its dividend from 50 cents to 54 cents a share, that's an 8% increase. Can you imagine if you'd be getting an 8% cost of living adjustment on Social Security? What if you got an 8% cost of living increase on your pension or your annuity payment? So part of the solution to staying retired is to make sure you're investing in slices of America. Those are great companies of America who historically have compounded their dividend growth rate at a rate well above, if not double inflation. And when you can build a portfolio of those great companies of America that raise their dividend every single year, if you're living off the dividends, then you're only living off the income, and your income is going to outstrip that silent killer. That's the key ingredient to win.
Yeah, and let's make that distinction, right? Because we can break dividends down into 2 categories. High dividend payers, stocks with high yields. Well, sometimes there's a reason for those high yields, right? Maybe the stock price went down and now it looks like we've got this huge dividend. But, if you're buying a high yielding stock, there's also a chance that dividend might get cut. On the flip side of that, you have companies that are growing their dividends. On the surface, might not look like a huge payout, but if you can get a dividend growth rate twice that of the rate of inflation, that to me proves that those companies have good margins, or else they wouldn't be raising the dividends in the first place. Let's maybe talk about a different category, Craig. Maybe we talk about something that's a little bit more unique, which is what are some other ways that we can generate dividends or inflation hedges on the equity side? And one of those ways that I really like is covered calls or income premiums. You can make that really complicated, or you can make it really simple with an ETF strategy. What's an example of a covered call strategy?
So if you are of the opinion and you're of the mindset that the stock market has run up so high and so fast in 23, 24, 25, and as you look out to 2026, you can't help but pinch yourself and say, I don't know that it can repeat for a 4th year in a row after hitting a tripus, then you too might be interested in some covered call strategy. So what is that? A covered call strategy is when you own a basket of stocks, broad and diversified, and you work with a portfolio manager to write or sell some calls. When you write a call or sell a call, what happens is you're giving away or capping your upside potential in exchange for getting paid a bunch of money that we call premium or income. So David, going into 2026, we might be in an environment after 3 years of wonderful gains. I call that the tripus. Shout out to that great company or that great movie, David. What was it called? American Anthem or something like that back in the 80s with Mitch Gaylord. You know I was going to go there. But my comment is, if you want to generate large income, premium income, as long as you believe that the upside for stocks is muted, so you're willing to trade some of that upside for very large income, a covered call strategy for a part of your portfolio is a great way to put a satellite position on top of those great companies of America to generate the income you need. David, some of those premium covered call strategies today are generating how much income and how much yield?
Yeah, north of 7% in a lot of cases. So let me parrot that back to you. So covered calls is a way to increase the income on the portfolio while owning equities. And the way I think about it is there are 3 scenarios. Stocks could go up, they could kind of go sideways or go down. So stocks go down, we end up with more income. Sounds like we win in that scenario. Stocks go gangbusters, dramatically higher. That's probably not a great thing, right, Craig? Because then our stocks get called away. Or stocks just are kind of moderate, more flat, we win. So out of those 3 scenarios, if you're of the belief the markets run up a little bit too quickly, in 2 out of those 3 scenarios, you've put yourself in a position to succeed. So I think that's a great complementary strategy, not your core strategy, to think about as the market roars higher right now. And as we get close to the end of the year, if you want to take some profits, it's a way to stay in the game, but maybe reduce your volatility.
So if you're just joining us, we're breaking down the big news that just came out on Friday. We finally got some government data. Yes, the government is still shut down. We had a 3% annual CPI run rate, but you know what? That came in a little bit better than what we were fearful of, which is 3.1. But the real news story is we get the inflation data at 3% at 7:30 in the morning, and then at 8:15, Social Security comes out and gives everybody a nothing burger, a 2.8% cost of living adjustment. And that's just my reminder that you got to be self-reliant. This is America, everybody. You got to be self-reliant, and that means having investments that are going to grow your income over time. So if you want to learn about how to invest in a slice of America, you want to learn how to move beyond just a mutual fund or an index fund, and you want to build a curated portfolio of individual companies that have a history of growing their dividend at what can be double the rate of inflation, and you want to learn more about pairing that with some satellite strategies, just in case you're thinking what some other people are thinking, that after hitting a TRIPS 23, 24, 25, 3 years of double-digit gains in stocks, it might be time to focus more on income and a little bit less on growth, then you need to give us a call. That phone number, 833-964-PLAN, 833-964-PLAN. Better yet, connect with us online at getretiredstayretired.com. That's getretiredstayretired.com. All right, David, when we come back, we got to get everybody some more sincere and actionable ideas that they can be using to make sure they thrive, not just survive in retirement. You're listening to Craig and David in the Know, VestGen Wealth Partners, AM 560. I affectionately call it The Answer.
You want more in the Know Radio? You want more in the Know Radio? You can't handle more in the Know Radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
All right, in case you didn't know it, well, the only way you wouldn't know it is you haven't been listening. The S&P 500 has been the go-to investment for those seeking broad market exposure. Notice I said broad market exposure, but America, come on. That might be changing. No, wait. It's already changed. AI-fueled growth in companies like NVIDIA, Microsoft, Apple, it's given them outsized influence. And did you know right now that in the S&P 500, the top 5 companies now make up nearly 30% of the index? So let me say that again. If your sole equity investment is the S&P 500, 30% of the S&P 500 is in 5 companies. Sit with that for a moment. And aren't all 5 companies somewhat interrelated? There has never been so much concentration risk in a broad-based index ever in the history of time. And when you see that, that gives you all the asymmetrical upside, but asymmetrical upside also comes with asymmetrical downside. And I am all in on AI enthusiasm. You know that. We've been talking about it. This is the AI enthusiasm market. You've lived through 3 markets in 9 months. You had Trumponomics. Then you had what? Recession paranoia. And then we moved into the current market of AI enthusiasm. But if you aren't careful, you might not be as diversified as you think. And if you're moving into retire or you're already there, while the silent killer long-term is inflation, the problem you really have is sequence of return risk. David, you have been talking about sequence of return risk with clients for as long as I can remember. Explain to us what sequence of return risk is, and let's go back and forth about how we can mitigate or neuter that away.
The way I think of sequence of return risk is when we are accumulating dollars for retirement, let's say from 25 to 65, what we care about over that long-term time period might be what's our average return. But we know over several decades it's going to be a bumpy ride, but we don't care on any given year what the return is. What we care about is the long-term return. Now, the reason for that is because we're not taking any money out of the accounts. We're adding money to those accounts. We're adding money to 401k every paycheck. but we flip the script once we start taking distributions. So I think the best example I could use is there's a huge difference between retiring in 2007 and then having a bear market 2008 versus retiring in 2010, where yes, we've had some bumps, but generally speaking, the market's appreciated. If you are withdrawing from your portfolio and then the market has a 50% decline, you're just compounding those losses. And if you don't have a plan, there's a good chance you're going to be forced to sell assets at low prices, and you'll never get back to even where you started if you retire into a bear market. So this is where the planning comes in and the foresight. This isn't just about investing for maximum return. It's about investing to actually stay retired. And you need to create opportunity and flexibility in your portfolio. And that means don't put all of your eggs into one basket.
Well, let's talk about the baskets then, because we are such firm believers in objective-based investing. Objective-based investing. Objective-based investing is where each dollar in your account has a very specific purpose. And when you do that, it aligns with your risk budget as well as your risk tolerance. So think about that as the now bucket, David. Talk to us about the now bucket, that no risk, that low risk bucket. What's going to be in there? What are the investments, and how much should be present in today's marketplace?
Yeah, I think the concept of that now bucket is it's not designed to grow significantly. It's designed to generate income and not lose any money. This is the money that you're going to consume over the first several years of retirement. And to me, I think we at least have to have 18 months of capital. But if we're honest with ourselves, we're probably going to want a little bit more. So maybe somewhere between 3 to 5 years of safe capital. What does that represent? Represents the first 3 years of systematic monthly withdrawals from the portfolio. And why do I use that maybe 3 to 5 year? Well, if we go back and look at, again, the worst case scenario of 2008, right, that was almost a 4-year recovery for certain stock indices, meaning it took them several years to regain their footing after that huge decline. But if you're retired and you've set aside enough capital to kind of carry you through, we're essentially just trying to buy you time so that the rest of the portfolio can continue to grow, recover, compound, reinvest those dividends. So that now bucket is high interest, and it's essentially laddered out so that you can look on your statement and see this is exactly where the money's coming from.
So if you're just joining us, we talked in our first segment about that silent killer, which is, again, the CPI data, the lack of a good COLA coming this new year for retirees. And now we're talking about the concentration risk in the S&P 500, where 5 companies literally make up 30% of the index. That's a lot of asymmetrical opportunity, but also asymmetrical downside risk. And one of the ways you neuter that or cure that is to make sure you're doing objective-based investing, where, again, every dollar has its own purpose in a bucket. So we just got done talking about that now bucket, how you're going to use no risk, low risk investments that are properly laddered out. Notice I said laddered out. It takes a team with talent to actually do the execution. And then, David, that gets us into what some people call the soon bucket, that intermediate term bucket. That's that money that you're going to start relying on 3 years and out. Talk to us about how that's curated and measured.
Yeah. So, maybe to keep it simple, we take one step out on that risk spectrum, right? So we're willing to assume a little bit more volatility and variability to generate above average income. I think that means you can have exposure to the stock market. You might have exposure to slightly longer dated bonds. You might have some exposure to non-traditional investments. But I look at that bucket as, hey, we need to grow above and beyond inflation. And we're probably going to take the income from that soon bucket and use that to replace the money we're spending in that now bucket. So there has to be a system in place with a team that can go through and refill that bucket. And guess when that bucket gets refilled? It doesn't get refilled just because it's January 1st or March 31st or June 30th. The market dictates how you kind of rebalance and recalibrate that portfolio. So it doesn't has to be a static approach just because there's a certain date on the calendar. You want to do that when the market's going up, right? The time to fix the roof is when the sun is shining. And this year is a great example of that. If you're an investor that's very comfortable and happy of how the market's done this year, now might be the time to, do a little bit of recalibration, I would say, as we go into the close of the year. Might as well do it at market highs. And that brings us then to bucket number 3, I think.
That's right. So bucket number 3, that later bucket, that's going to be all those assets that you don't expect to tap for income until they're 7-10 years out. That's the bucket that's designed to go ahead and build wealth for the future. That's the bucket that helps you guarantee you outpace inflation. That's the bucket that allows you to feel secure because you're going to do the miracle of compounding. But what David said is you got to make sure there's this system. There's got to be a systematic, repeatable system that's tested in the trenches in order to have the financial professionals who represent you rebalance between these buckets. And it shouldn't be done on a calendar base. It needs to be done through dynamic rebalancing, which is you let the market dictate the opportunities and the threats of how you navigate. And that's why you need to work with a team. You need to work with a team-based approach where there are multiple professionals all working under one roof with multiple disciplines to actually pull this off. Because if you don't want something cookie cutter, you want something bespoke, it's a team-based environment that's going to go ahead and get this done. So I know you want to learn more. You absolutely can. Connect with us online at getretiredstayretired.com. That's getretiredstayretired.com. Take advantage of a complimentary visit. Talk with myself, David, one of the other professionals inside of VestGen. 833-964-PLAN. That's 833-964-PLAN. Getretiredstayretired.com. America, I think the fourth quarter is going to remain good, but this business has no room for complacency. None. If you're complacent, you're eventually going to get caught off sides. And if you get caught off sides, it could be the sequence of return risk. It could be the dramatic amount of concentration in a very few names in these broad-based indices that bring a whole lot of hurt. You got to find a way to stay in the market, but hedge yourself from those concerns. And that's why using the bucket-based approach, or what I refer to as objective-based investing, where every dollar has its own purpose relative to how it's going to be consumed, when it's going to be consumed, how it's going to be taxed, leading you to a bespoke investment platform. That is exactly where you need to be if you want to make sure that you aren't just surviving, but you're thriving in retirement. Because you know what thriving means? It means you worry less. And if you worry less, you live more. And if you live more, you get to pursue all these things that you worked an entire lifetime for. So let us help you do that. 833-964-PLAN, 833-964-PLAN. Connect with us online. GetRetiredStayRetired.com. You're talking to Craig and David Bolanos, VestGen Wealth Partners, on your favorite station, the station that's got all the answers, AM 560.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
I call this Rip from the Conference Room direct to the radio. If you want to know what are the conversations that are happening today, I think a lot of them centralize and revolve around this. There is this traditional view in retirement planning about what people need versus what they want in retirement. And there is something that we are seeing consistently and constantly, which is why the retirement cash flow process needs to be vetted. I would say it needs to be turned on its head. I would say we have already done this with our dynamic scoring at VestGen Wealth Partners, creating a set of guardrails for that corridor of spending. Because you know what I'm seeing? I'm seeing a new car, and it's a normal new car. That thing could cost you $60,000. Yeah, that's $60,000. And if you got to take that money from a retirement account, now you got to take out how much just to net the 60 grand? And have you seen what a wedding or a funeral costs these days, let alone anything else? So David, right from the conference room to the radio, talk a little bit about the conversations that you're having with all of these people living on 123 Main Street, those who are family-centric, comfortable, non-flashy, have traditional values, and just want to be doing better. Give us some insight as to what those look like today.
I'll break it down into two categories. Conversation number one is for those that have made it, right? Those families that say, you know what? The last 3 years have been better than a lot of people expected. We feel like we've made it, happy that the markets moved higher. How do we hold on to it? And so that gets exactly to what you said, Craig, which is we have a significant amount of concentration in the equity markets today, and probably for good reason, right? Like the profit margins on those, 5 to 7 companies are fantastic. But if you've kind of internalized that you've made it, now is a great time to recalibrate, level up your investments, and start diversifying. And that doesn't mean make a market call, and that doesn't mean get out of those stocks. It just means perhaps you take some profits, put funds into some other strategies for a rainy day, and then look for an opportunity to perhaps reinvest in those companies if we do end up getting a larger market correction. The other conversation that I think has come up with more frequency is those that are just several years out and really trying to drive home what it's going to take either on a monthly basis or some of these one-off events. So if you're a successful family and you're making several $100,000 a year, and in your head, you're thinking, hey, I can live off, 70% of that money when I retire. I guess my question back is are we rationalizing that we want to leave work so bad that it's I'll just make it work? Or are we being honest what this is really going to cost? So you mentioned two things. I think this is a big deal. If you retire and then year one of retirement, you're buying a new car for $50,000 and you're paying for your daughter's wedding, think of that as a percentage of your portfolio. Right there, that could cost $100,000. If you've saved $1 million, you just took $10,000 out of your portfolio in year one of retirement. And that doesn't even include your monthly distributions to replace your paycheck. So let's be honest with what some of that stuff is really going to cost. Scenario two, what's the real rate of inflation? The government likes to tell us it's about 3%. When we run retirement scenarios, we run multiple scenarios with inflation because I got to make sure that if that number is not actually the real number, that we can make it work at these various levels. And that doesn't take a lot of extra work. It just takes having the conversation and then running these various scenarios. And I think part number three to me is what about the opportunity set that you have with your employer? Meaning, if you decide that you might have to step away 1 or 2 years earlier than expected, do you have that safety net? And that safety net could just be cash flow, but it could also revolve around retiree healthcare. I've had several conversations with clients this year who have had companies get spun off and in the spinoff lost their retirement healthcare. So we had to pivot. Luckily, the money was there and find another place to go ahead and get that healthcare to bridge the gap into Medicare.
So, David, these are all really big topics. And here's your takeaway. I'm calling this from the conference room direct to the radio. That retirement planning process needs to be much more authentic. And you might not even know where to start. You might not even know what it's going to cost. Listen, we have clients all across this country. And while everyone is unique as their common denominator of their last name, there are similarities between everybody. We already know, based on where somebody lives, based on what they currently earn, based on their family construct, we have a good idea as to what it's going to take. I think you want to know that information. Visit with us. We'll be real about it. And then because we're real about it, we're authentic about it, we expose that everything is going to likely cost more than you think it is, you can start curating your investment and your cash flow strategies to do your best to marry to not just your needs, but to satisfy those wants. I think that's so critical. And that's why it takes, again, a multi-family office, which is multi-professionals, multiple disciplines, all coming together under one roof to service you. Because the solo advisor model, can't get this done, you need to work with a team. 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com, getretiredstayretired.com. David, stay on this subject about conversations from the conference room being brought to radio. What else are what are you hearing that people might be surprised or people might nod their head and say, yep, that sounds just like us?
I think the inflation one, I mean, in every meeting I've had in the last year, I have suggested to people, I think the two largest hurdles we face is income taxes and inflation. And while I think we've handled the income taxes, right, that we're not getting a massive increase in 2026, I think the number one thing people feel is folks that are well capitalized, they know that when they go to the store or when they pay those bills, things are more expensive. And it's very evident. It's so obvious to them. And so monthly distribution plans have had to change, meaning we've had to increase the amount of money that we're sending out, not to improve their lifestyle, but just to maintain the lifestyle. And I think post-COVID, right, like this stuff was accelerated and the bumps came sooner than people anticipated. They thought, hey, if I'm making up a number, $6,000 a month from my portfolio, that $6,000 we can probably keep static for the first 10 years of retirement. That's not the case, right? If you've retired recently, that number's had to move up very quickly within the first 1 to 3 years of retirement. So I think that's changed the way people think about investing. And I think that's pushed them to think about what's it going to look like in 5 years. And this is why it makes me nervous. I understand CD rates were very appealing the last couple of years when they started with a 5, but now they start with a 4, and they're eventually going to start with a 3. So when you're locking in those CDs, there's always a place for cash in a portfolio. You got to be careful. If you're over allocated to cash, you have serious reinvestment risk moving forward. And so we've got to find some alternatives to cash without jumping into the stock market so that we can keep up that purchasing power without subjecting you to, a portfolio that's a little bit too volatile. But I think that's the big thing that people should be thinking about is if you have maturing CDs, what's your next step? Even if they don't mature tomorrow, they mature next year, what are you going to do with that capital?
Reinvestment rate risk is real. And over a long-term time horizon, nominal returns, we'll talk about what that are. Nominal returns, they lose their meaning. But real returns, a real return measures wealth creation relative to the cost of everything else. That's where your focus needs to be. So you got to stay tuned because we're going to talk about real return investing and a thematic that you got to be getting in front of, which is everything that AI, artificial intelligence, can't replace and everything that artificial intelligence can't reprice. Because if you start focusing on real return investing and you start focusing on a thematic of what AI can't replace and AI can't reprice, I think you'll be solving a couple of things. You'll be solving for the concentration risk in the S&P. You'll be solving for that sequence of return risk. You'll be solving for all these other asymmetrical problems that are out there because you'll have a more robust platform and template to work off of. Who's going to give that to you? Yeah, it's Craig and David, VestGen Wealth Partners, AM 560, The Answer.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
So I mentioned this concept that over a long horizon, nominal returns lose their meaning. Real returns, though, do measure wealth creation relative to the cost of everything else. What's that nominal return? That's kind of a geeky way of saying, hey, your investments return 10%. That's the nominal or the gross return. But what's the real return after inflation and after taxes? Because real return investing measures wealth creation relative to the cost of everything else. And you heard a certain theme today. And the theme I want to remind you of is history doesn't always repeat itself, but it sometimes rhymes. And remember 1973 to 1983? Yeah, you do. The music, It had some edge to it. It wasn't all pop. The beer was cold, the parties were good, and the Dow Jones did make great progress from 1973 to 1983. That was the nominal return. But what was the real return during that period? Because of rising inflation and escalated income taxes. Oh, yeah. If you were retired back in 73 to 83, the only reason the normal person did fine is they had reasonably priced healthcare and they had pensions. Hey, today, America, do you have reasonably priced retiree healthcare? No. Hey, America, do you have a pension? Probably not. And you heard what we said earlier in the show. This 2% mandate for inflation, we're not getting there. The latest print, which we just got on Friday, was 3%. 3. It's not coming down. And if this continues, what are you going to do to secure your future? So, David, I think this is not a little story. I think this is an everything story. And we're going to break down 3 quick stories. Part number 1, David, talk about the current de-dollarization issue and why we need to solve for currency risk. Well, I'll tee it up for you and you'll chime in. David, I've seen the US dollar drop against the euro this year. That meant if you went to Italy in January, it was a lot cheaper than going to Italy this fall in October, November. I know for everybody who wants to drink a margarita and a cerveza and go to Mexico, it was a lot cheaper to go in January than it is today because that US dollar is not buying as many goods and services as it used to. And everybody knows the US dollar has been going down because of de-dollarization. What's de-dollarization? It's all of these other countries who have screamed for decades that we're probably too heavy in US dollar denominated assets. But you know why they put their money all in US dollar denominated assets? Because America is awesome. America is exceptional. And we have been the world's bank. We remain the world's bank. But you know what? Other countries now recognize that we hold the cards. Other countries now recognize that we carry a big stick. And other countries don't want to be as dependent on the U.S. now. Other countries don't want to be as dollar denominated. So every single month, they still buy U.S. government bonds, but they're buying a little bit less. What are they buying instead? They're buying gold. They're buying silver. They're buying digital assets, and they're buying other currencies like the euro, the yen, and the pound. And here's the problem. There's the inflation data I talked about on Friday, CPI, 3%. But what about the currency inflation? When you find that your dollar, what you spend, buys 14% less euros and 13% less Mexican pesos than it did at the beginning of the year, how you solving for that? You'll solve for that with real return investing. So call me today, 833-964-PLAN. 833-964-PLAN. Go out to our website, getretiredstayretired.com, getretiredstayretired.com, and tell us that you too are ready for real return investing. David.
So, Craig, what you're saying is really since February of this year, the U.S. dollar's declined about 12 to 13%. Why? Other countries are still buying our treasuries, but perhaps not buying as many of our treasuries. And the tariffs have kind of spurned this on. Where's the rest of the money going if they're not buying treasuries? Other currencies, gold, and then we have individuals and maybe some other places also investing in crypto, right? So with this debasing of the dollar and $37 trillion of a debt, that's not serving us well because we can print more dollars, which is a problem, but you can't print more gold and you can't print more cryptocurrency, right?
That's right. There's a principle of scarcity. That's it. And speaking of scarcity, that's investment theme number 2, guys. Everything that AI can't reprice and everything that AI can't replace. And there's a couple of things I think about from a thematic standpoint that need to be in your portfolio. Number 1, does AI live without a data center, David?
Nope.
Can AI transmit its data into and out of that data center without cell towers and fiber optic networks?
Nope.
Can AI run in that data center and do its transmission through cell towers and fiber optic networks without consuming a tremendous amount of power?
Of course not.
So wait a second. So you know what that means? Something that AI can't replace? Data centers. Things AI can't replace because they need them, cell towers and fiber optic networks. Something AI can never replace because it's solely reliant upon mass amounts of power consumption. Guys, you need to be investing directly in energy, all forms of energy, because different countries are going to do it in different ways around the globe. And if you start moving incremental pieces of your portfolio into those operating platforms, you too are going to be further diversified. And with markets trading at all-time highs, with massive concentration risk in just the S&P 500, a part of rebalancing those buckets is an adoption of that thematic.
Yeah, now let's wrap that into our prior theme with inflation, right? So when we think about fiber optics or towers, how are those investments done? They're typically done on long-term contracts with inflation kickers in them, meaning they can raise the rent. So if we're looking for additional inflation hedges above and beyond dividend growing stocks, then we want to have long-term contracts with things that are essential to make the world work, right? Where we have consistent cash flow and in certain cases, tax efficient dividends. So this is how we put all this stuff together, right? Now we're implementing the taxes, connecting that with the investments to the issue, which is this issue of a debasing of the US dollar and silent inflation, which probably isn't silent anymore.
Absolutely. So you know what? These are the things that you need to learn more about. If you're just having conversations with your advisor and it's about, oh, here's your 60-40 portfolio, it's not going to get it done, guys. It's not going to get it done. We live in a world of rapid change. The world has already changed. We just haven't seen the changes. Again, we're all going to wake up by 2027 and wonder what happened. And we all know what's happened. AI is transforming everything. And think about the stories that are in the headlines. Does anybody know what the current jobs data is? I don't think so. But I think once we start printing the jobs data, you're going to see that the unemployment rate's been ticking up. Of course it has, because you know people who are now out of work and it's taking them a longer time to actually get rehired. So I'm not surprised at all if the unemployment rate by the end of the year has jumped to 4.5%. And that's not because AI is taking any jobs right now. AI is not replacing jobs yet. But what companies are doing is they're firing workers to save money to invest in building out AI, which is eventually going to take their jobs. And the crossover for that is probably 2027. So when you think about the fact that we could be heading into a place where the unemployment rate goes up dramatically starting in 2027 because of potential job losses, then that means there's going to be an entire classification of people that are going to need to be helped and cared for. And if that means we're going to be relying on basic social nets to help and care for those people, where do you think your taxes are going to go? So I love that the Tax Cut and Jobs Act has been made permanent under OBA, the One Big Beautiful Bill Act, but it's only as permanent as having three branches of legislation that are all unified under the current party. But in the future, it's going to shift. And how are you going to future-proof yourself? David's going to give you an idea to future-proof yourself coming into the end of the year when we come back. 833-964-PLAN, 833-964-PLAN. Get retired, stayretired.com. Tell us that you too are ready for real return investing going into 2026. Craig and David Bolanos, VestGen Wealth Partners, AM 560. The Answer.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
A big part of what we do at VestGen Wealth Partners is future-proof you. That's right, future-proof you. We've been talking about that the entire day. But a part of future-proofing is you come into the end of the year. After all, guys, it's Q4. There's not that many weeks left in 2025. Is you got to say to yourself, what are you going to do to neuter away an event that I think is going to happen. Unemployment is going to rise. It's undeniable. That is courtesy of not the industrial revolution, but the AI revolution, which means social safety nets may need to increase, which means the government's going to come back and tell you they got to raise revenue. David, what are two simple strategies or two acronyms people can use going into the end of the year to future-proof themselves?
Control what you can control, which means don't worry about the stock market bubble. Make decisions that you can actually implement in your portfolio. And I'll give you two simple ones: HSA and Roth IRA. Taxes, taxes, taxes. And this is open enrollment for a lot of people starting soon. So make sure you go into that corporate benefit website and sign up for the right stuff, including Roth 401ks, HSAs, etc.
Remember, there's no room for complacency. There's no room for complacency in investing. There's no room for complacency in taxes. Everyone breathed a big sigh of relief that the One Big Beautiful Bill Act came in and renewed the Tax Cut and Jobs Act, but I can't afford you to be complacent. So learn more, get involved, use that Swiss Army knife that's the health savings account to go ahead and create a preordained bucket through which you can pay your retiree healthcare premiums. Who wouldn't want something that's tax deductible, tax deferred, with tax-free distributions that can be invested for growth over time? And likewise, you all know Senator Roth. Yep. These Roth IRAs have been around since 1998. They're more widely adopted now than they used to be, but I'm worried that they're under-adopted because people feel, hey, tax rates are permanent. Again, they're only permanent up until they change. So make sure you're filling up your brackets every single year. Make sure you're threading the needle for IRMA, and make sure you're working with professionals, though. Now the taxes are a little bit more confusing because there's income limits for the new enhanced SALT deduction. There's income limits for the new $6,000 senior deduction once you're 65. You'd hate to inadvertently do a conversion and lose any of that. If you want to learn more, I know you do. You can. Connect with myself, David, any of the team members. We're a phone call away. 833-964-PLAN. 833-964-PLAN. Get out online. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. All right, everybody. Have an awesome Sunday. Chicago sports, I think we're crawling back onto the good side. I love it. You love it too. Let's make sure we don't survive in retirement. I want you to thrive in retirement. In the know, Craig and David Bolanos, VestGen Wealth Partners.